Welcome to the Multifamily Investor Nation podcast. I'm Whitney Elkins Hutton. I'm the Director of Investor Education here at PassiveInvesting.com. And today with us, we have Dante Belmonte. Dante, welcome to the podcast.
Hey, Whitney, thank you so much for having me. I really appreciate the opportunity to come on your show and chat with your listeners.
Absolutely. Well, before we dive into the details of the Abbey, a 44-unit multifamily in Hickory, North Carolina, talk to us a little bit about your background and how you got into the multifamily space and where you are today.
Yeah, no, I appreciate the opportunity. So I'm fairly young. I'm only 25 years old. So I've been in real estate since I've been 18, though. I got my real estate license when I was 18 in upstate New York. And I've really primarily niched down into selling multifamily. So that's my main go-to source of income. And it has been for the last about 7 years is selling multifamily property. And once I was selling these assets and seeing how these individuals were, and the investors making money and really building wealth for themselves, I wanted to participate in that too. So I found long story short, found a partner that I knew for 15 plus years. And we started buying apartment buildings together about 2 years ago now.
Amazing. Well, let's dive into the deal because, as we get through our questions in that deal, I think we're going to get a little bit more intimate knowledge about how you crafted this partnership and just the speed of which you were able to pick up this apartment and close. So let's start off. When did you acquire this property and how did you find the deal?
Yeah, so we actually closed on the property in early July of 2022, and the deal was brought to us off market by Cushman & Wakefield, and we've done transactions with them before. They knew us in the marketplace because we own several other assets. They know we can close, and this was an opportunity where they had a very skittish seller, where the seller didn't want it on the market. They didn't want people touring the asset. They didn't want the tenant to know. They didn't want the property manager to know. So they asked Cushman & Wakefield, can you bring a small group of individuals? And we were one of those individuals that had the opportunity to offer on this property.
Amazing. Okay. So how many other groups were also looking at this property?
To my knowledge, so I don't know how many were looking at it, but to my knowledge, I know there is only 2 other offers. And our offer was actually lower than the other offer that they had on the property. But again, that relationship that we had with them had a presence in the market and very good terms on the deal. I think the broker and the seller felt very comfortable moving forward with us on the deal.
Okay, so I want to dive into that a little bit deeper. So you get this off-market offer or come across your desk, and you're in a small group of people that are looking at this. Like, how did you approach that? Did you go immediately to the property and start, walking a couple units? What did you see in this property and, that was immediately lead you to believe that this was a good property for your capital group?
Yeah, so typically with the off market, they don't have you tour the asset until an offer is in place, just because they want to make sure you're serious, not kicking tires. And the opportunity we saw at this asset, it's a beautiful asset built in 1982, which is our buy box. It's got a resort style pool, elevator, a laundry facility on all 5 floors. So each floor, solar panels on the roof, just an overall really good asset in a medical area. So there's a lot of doctor's office and medical offices nearby, plus really good restaurant, retail, and a college. So it had a lot of activity in the area and a lot of growth. But the biggest thing was this was a one-time owner. This is the only property they owned. It was a husband and wife. They've owned it for over 10 years, and they really weren't maximizing the potential for this property. They had the property manager was one of the tenants. They lived in the units for free. They were getting very low salary and renovated 1-bedrooms in this market with all those amenities. We're at an average of $650 a month. And we're like, these should be at least $800 to $850 a month. And so we saw it had so much meat on the bone. And these were renovated units too. New vinyl flooring, new paint, new fixtures, new trim. So we knew the opportunity was there, where it was more of a management play. It was more of a functionality. It wasn't more of a value add where you have to go in, renovate the units, rebrand, do all these things, where we know it was just a functionality play. So we saw a lot of value there, and that's why we pursued after the asset.
All right. So how did you structure your offer? There's a small pool of potential buyers looking at this property, and you already mentioned that you came in below the other offer on the table. How did you structure your offer, and what do you think clinched it for you?
Yeah, so I think what it was for us is we had a lender in our back pocket that we have done business with already. So all of our documents were in. We closed the deal with them the month before, and we spoke with them and we said, "Hey, how fast can we close this deal?" And they said we can close it in 30 days. We talked to our lender, we talked to the survey company, we talked to the third party inspections for environmental, and we said, if we order rushes on everything, how quick can you guys do your job? And they all said about 2 weeks. So we came in with a strong price. It wasn't super high, but it was strong. We came in with a very strong deposit. And then we said, we'll close on this asset within 30 days. And I think doing a quick close was something that the seller was very interested in. They were also looking to move out of the area. So just having really aggressive terms and not dragging out due diligence, dragging out, terms and contingencies, and having financing in place, I think that was something that was very attractive to both the broker and the seller.
All right. I want to definitely dive into the lending portion of this here in a minute, but let's talk about the due diligence side. So you have your offer, it gets accepted. So, you've given us a little bit like time to, purchase sale agreement to close was about 27 days. Walk us through the rest of the timeline in the offer, particularly inspections. When did you get to access the property and start walking units? And, when did you have any money down and did it go hard?
Yeah, so we actually, because this was right when interest rates were going crazy, we did not put a non-refundable deposit down. We haven't done that in our last several deals, not because we feel like we can't close the asset, but we feel like the debt market is so volatile right now that it's out of our control. And a lot of brokers, good brokers, will realize that, and they won't say, "Oh, you got to put hard money down to do a deal, a non-refundable, deposit." So I'm in New York, my partner's in Charlotte. Literally the day we signed the PSA, I booked a flight for the next day. I flew down there and we were able to access the property for due diligence, aka inspections, immediately. So we brought our general contractor, plumber, HVAC, electrician, property manager, and of course ourselves. And we went through and we walked every single unit, common areas, roof, leasing office, elevator, everything, laundry facilities. And we had, I believe it was a 15-day due diligence period, but we didn't want to mess around. If we found something, we wanted to know right up front. So we were super proactive about it. And also we syndicate. So we have to raise capital. So that's another thing we have to do within those 30 days. So not only were we doing due diligence day one, we also made sure our securities attorney had everything they needed to start drafting up our documents. And we paid even a little extra to get those documents expedited over to us.
Oh, wow. Okay. So when, so you're there on property, within a matter of like hours, it sounds like.
Yep.
So when were you complete with due diligence, and did you uncover the physical due diligence, and did you uncover anything in that due diligence?
Yeah, so physical due diligence, especially on a 44 unit, it's such a small property that we can do all the physical on-site due diligence in a day very easily. So we walked all 44 units. Walked the entire property. We did it in one day while I was there. And during that day, we also drive all the comps for the sale comps and the rental comps nearby. We don't just look at them on paper. We actually visit them to make sure the numbers on paper actually match in person. So I hope that answers your question. We did all the physical in one day. As it's a very small asset, we didn't have to split it up into multiple times.
And did you, with it being a 1992 property, did you find anything, issues with the roof or
So it was
anything like that?
Yeah, so it was actually 1982. We try to be 80s and newer just because of lead, asbestos, galvanized, lath and plaster, all the construction aspects of it. So when we're going into due diligence, we bring the electrician so he can check the wiring. Is it aluminum or is it copper? Is it stab lock breakers? Is it fuses or is it regular circuit breakers? We bring the plumber with us so he can check and say, here's your hot water tanks. Is it PVC drains? Is it galvanized drains? Is it copper? Is it PEX? And we look at all those items, and then we bring a roofer over to have him go look at the roof. And the roof was recently done, and it had a transferable warranty, so we were very comfortable with that. And just having everyone on your team, it's a team sport. It's a team effort at the end of the day. So it's kind of funny when every time we go in a unit, we open the door, it's kind of like everyone breaks to their position. The electrician goes, to his spot. The plumber goes right under the sink and whatnot. And, we're checking furnaces and all of that. So we didn't find anything that was surprising to us. We didn't have to trade the price on anything we found physically in the asset. Because I do have my partner go drive by the asset and walk around the exterior before we submit an LOI typically, just to make sure the number aligns with what we're seeing. Obviously, we can't get into units until we tour the asset. And we were very comfortable with everything we saw. And I think also the broker did a very good job setting expectations. I think that's huge. He wasn't sugarcoating anything. He told us where the good and the bad was, and we were able to perform that in our underwriting.
Awesome. All right. So, and what was the purchase price of this property?
Yeah. So the purchase price we originally went in was 4.25 million. And while we were under contract, even during that due diligence period, our interest rate that the lender told us was going to be higher than what we thought it was going to be. And so we were very upfront with the seller right in the beginning during that due diligence period. And we said, hey, listen, here's where we got quoted. Here's where it is now. And we showed him proof, and we were just very transparent. We'd love to buy the deal, but the numbers don't work at this number. So we went from 4.25, or maybe it was 4.15. I don't remember, but we ended up ultimately at 3.95 million, which is about 89,000 a door. And we're extremely, extremely happy with 89,000 a door, considering it's an 80s vintage. It's got good amenities. It's in a great location. And it's more of a C+, B- asset. And the property 3 doors down just sold, that's 10 years older, for 130 a door. So we knew our going in basis was already very strong compared to other comparables in the market. And that's why it appraised also for 15% greater than what we purchased it for.
Oh, amazing. All right. So what kind of debt did you put on the property?
Yeah, so we did a fixed bridge debt option. So we didn't look at an agency option, mainly because it would have taken too long to close. And the income was so low that we felt like our leverage would get compressed too much. So we recently did a bridge loan with this lender. It's fixed rate for 4 years, no prepayment penalty after 1 year. And I believe it was 6.99% at the time, which is, in today's environment, that's still a really good bridge debt on an asset like this that's fixed for 4 years. A lot of agency loans in the last 4 to 5 months were 6.9% regardless. So being able to get bridge debt on this loan was great. I think we ended up at 70% loan to value on purchase. And then the lender also gave us 70% loan to value, or I should say 70% of our CapEx budget as well.
And what did you have for a CapEx budget?
I believe the overall CapEx budget was about 300,000. So, something I mentioned earlier on is majority of the units were renovated. And I should also mention this operator was also using, or this owner was using, one of the units not only for a property manager, but they were using a second unit for storage. So that unit was completely offline as well. And it's only 44 units. So you're talking a good percentage of the property. Mm-hmm. So the CapEx that we had was a majority of cleaning up, sprucing up the outside, new awning, new signage, just cleaning up the exterior, money to renovate, because that needed a full gut. That storage unit hasn't been used in probably since the property was really built. And then just touching up other units and having a good reserve on our backside as well. Because the nice thing about the CapEx fund that's getting basically in draws is it's there if we don't need it. So we're not drawing on it right now. We're not paying interest on it. But if we do run into something where we do need it, we overestimate that budget. So we have that opportunity to draw that if we need to.
Okay. And did you have to place that CapEx budget, because I've heard some people, especially in, this run up on interest rates, that banks were really nervous. And so they required them to keep a certain amount of funds in the bank.
Like an escrow account?
Yeah. And like untouchable.
Yeah.
For 1 year.
Mainly because we've done business with them before, they didn't require it. What they did require was 3 months of escrow, or 3 months of debt service up front. So they would take 3 months of debt service, put it in an escrow account. They wouldn't make us pay the first 3 months. They would just pull it from this escrow account. So that's really the only portion of additional funds they required. That's pretty standard. And it's not like we're double paying our mortgage payment, because for the first 3 months, we're physically not paying it. They're just drawing it from that account, which in our modeling, we still model it as if we're paying those 3 payments. So that way we have adequate reserves in that aspect as well.
Okay, amazing. So you said you syndicated this deal. Talk to us about the partnership structure and the various splits, and then, the amount of capital that you had to raise for this deal. How did that?
No, great question. So My partner DJ and we run our company, but we do have one other individual that will typically sign on our loans as a KP, just because we don't meet that 5 years of experience yet, because we've only been doing this for 2 years. So it was a $1.5 million equity raise. So that includes the down payment, closing costs, any fees and reserves and prepaids. And we were able to raise that in less than a week. So where I talked about earlier, we had our securities attorney get the PPM, the operating agreement, the subscription agreement expedited. We put it out to our network. We have a phenomenal network of investors, and we oversubscribed the offering of 1.5 million in less than a week. And the split that we took down for this opportunity was, we did a 7% pref or preferred return, and then we did a 75-25 split, 75 going to the LPs, 25% going to the GPs.
Any other hurdles in there? Any other IRR
Nope.
hurdles? Okay.
So we don't do any IRR hurdles, just because I like the belief of, a confused mind takes no action. So if you have this really complicated, IRR hurdle to a retail investor, that really just doesn't understand, they might get really confused by the investment and therefore not invest in it. So if we can make it very simple and very easy, like we do in all of our investments, it's very easy to understand and they'll move forward with it. And we've had no issue with that.
Okay. So talk to me about the general partnership structure. So you have the two partners, and then also the key partner that's helping you secure the assets. How are you dividing out that particular pie of money?
So typically, I like to say we're kind of like a one-stop shop. A lot of syndicators we'll raise capital, we'll do the asset management, we'll, sign on the loan. There's all these different roles. We do all of it. We sign on the loans, but we also have an individual that signs on the loans for us. So my immediate partner and I, we find the deal, we put the deposit down, we do the asset management, we do the capital raise. We'll do everything for the deal. So there's really no split. I'd probably say you could, jock it up to like a 90-10 split. My partner and I are 90% of the GP. That individual that signed as our key principal or KP, I think he ended up with roughly 10% of the general partnership. So again, very easy, not very complex, and just kind of easy to understand.
Okay, awesome. All right. So let's talk about, were there any additional due diligence issues that came up? Like say with insurance, did that go pretty smooth?
Yeah, insurance was great. Typically when I go to submit an LOI and I have a signed LOI, that's when I'll start to, talk to our insurance company and get quotes. And again, because we've done a decent amount of deals in the past, and I also look at a lot of opportunities, I know roughly where insurance is going to sit. So we're usually pretty spot on. And then to tighten it up, we get it quoted out. Debt, we always get quoted beforehand. Landscaping, pool control, elevator, maintenance, everything we get quoted out in advance, because we want to be prepared. We don't really want to retrade on the asset again if it's something that's in our control. So when we go to due diligence, it's really just to get into the units and make sure that it's exactly what we expected. But usually everything else is up front and we know it, we have it quoted out, so we don't run into too many issues. Survey was clean, came back very good, no encroachments. And like I said, that appraisal came back great. It was above what we purchased at. And then looking at third parties like environmental and, phase one, things like that, very clean. So it was very smooth. I can't complain. I wish every deal was like this.
Right. Well, talk to me about, the fees that you took on this deal, because I think that's something, that a lot of listeners find very unique, operator to operator. Did you guys pay fees, and how did you structure that?
Yep. So I think we have a pretty generous split at that 7% preferred return and that 75-25 split. Our fees are pretty standard across the board. We have let's see here. Let me just get it pulled up because I actually don't remember. So looking at this deal, we did about, because the purchase price is a little bit lower, we did a 2.5% acquisition fee. We do a 1% asset management fee, which is, of the annual income, and we take it quarterly. A 1% refinance fee. So if and when we refinance out of that bridge debt, we have a 1% of the new loan amount, and then a 2% disposition fee. So I kind of say a 2.5, 1, 1, 2. So 2.5 acquisition, 1% asset management and refinance, and then 2% disposition. And we find those to be pretty fair and standard across the industry.
All right. So you have a disposition fee in there. What is
Yep.
your end goal with this asset?
Yeah. So really, when we go into a business plan like this and a property that's obviously undervalued and not meeting its full potential operationally, we'll go in, we'll increase those rents to not what market is, but maybe a little bit below to leave room for us and the next operator. And that's really what we've done with this asset. And our business plan is to hold on to it for 5 years. We say 4 to 6 years, but what we'll do when we go to exit this asset, we'll look at it and say, okay, what is the price per door we're purchasing it at? What are we seeing similar price per door on similar assets selling at? And do we think we can exit at a reasonable price per door? So we bought at 89. We plan to exit at 140 a door. And we think that's extremely reasonable in 5 years because we know other assets that are older are already trading in that market at 130 a door. So we can make the assumption this asset's most definitely going to increase to that 140 a door within 5 years, no problem.
All right. So I'm an investor. I'm looking at this deal and it sounds amazing right now. I'm looking at your exit plan and I see that your exit plans for 5 years and the debt's for 4. What are you doing in that extra year?
Yeah. So I like to say we have multiple exit strategies. So if the prepayment penalty goes away in the bridge debt year one, and it's a fixed rate, so we know it's not going to adjust on us, we don't have any rate caps, that gives us 3 exit opportunities, year 2, 3. So year 2, we can either sell the asset, we can refinance the asset, or we can keep the bridge debt that's fixed in place. Year 3, we can sell, keep it in place, or refinance it. And then in year 4, because the bridge debt is now coming due, we either have to sell or refinance the debt. So each year we're going to evaluate where the asset's at and say, hey, do we want to refinance right now? Or do we want to hold it for another 2 years and either sell or refinance at that time? And we can reevaluate next year. We're not pinned into a corner where a lot of operators only have 2-year floating bridge debt. So it gives us options. So then, the asset's performing better than we thought at this time. So maybe next year we will look at opportunities to refinance and get us to that 5-year, maybe 6 years, maybe 7 years to see how it's cash flowing. Or maybe we get an offer for that 140 a door next year and we can just really, juice the IRR that way and just about double investors' capital within 1 to 2 years. And we have no problem. And that gives us very little risk. And that also lets us sleep really well at night, knowing we have fixed rate at a good term as well. It's not a 2 or 3 year term. It's a minimum. It's a 4-year term, which is great. So that's going to be our opportunity. And that's how we tell it to investors as well. We never look at a refinance in our numbers. We never calculate our numbers based off a refinance, because in my opinion, that is speculating, which, in real estate, we always speculate, but that's a very large, you're speculating very large there. And it also is a lot of risk.
Mm-hmm. Yeah. I always, if I see a business plan that has a refinance in it, I always like asking for the underwriting. So me personally, I can take that refi out and see if the deal still works.
Exactly.
Yeah.
Yep.
All right. So just wrapping up a little bit, this deal sounds like it was a dream deal. It came together very smooth. However, I would, just thinking through this process, is there something that you thought would be easier that ended up being harder? And was there something that you thought would be harder that ended up being easier?
Yeah, so I'm going to go with the latter just because it did go very easy and there was nothing that was harder than we thought was harder than we thought was going to be easy. The capital raise went really well, the due diligence period, everything. I would say the capital raising side of things was easier than we expected. We thought it was going to take the full, 3 to 4 weeks before we were to close on the asset. And when we oversubscribed the opportunity, because it was such a small capital raise, we were like blown away. We're like, well, we should be looking at larger properties now. If we have more investors than we do deals available, we need to look at our larger opportunities. So I'd say that's probably the one that was definitely easier than we thought it was going to be.
Awesome. All right, Dante, thank you so much for joining us today and sharing your expertise and insights with us. If listeners want to find out more about you and follow you, how can they do that? How can they reach out to you?
Yeah, so they can, I'm on all social media, Dante Belmonte, but you can also visit our website at victorycapgroup.com. That's victorycapgroup.com. And you can reach out directly to me, Dante at victorycapgroup.com.
Awesome. Well, again, thank you, Dante. for spending your time with us here today. And we look forward to hearing about your progress as you grow your company over the next few years.
Awesome. Thank you for having me, Whitney. I appreciate it.